Chapter 3. Working with Financial Statements. In this chapter, students should focus on how to use financial statements to obtain the information needed. Chapter 2 describes two main financial statements, balance sheet and income statement. However, if we want to know more about the financial health of a firm, if we want to know the relative status of one firm to its competitors, the absolute number reported in the financial statements may not provide us with enough information. This outline lists the contents of this chapter. Students should have the sample financial statements ready before moving on. One basic method to analyze a firm's financial statement is to standardize it. For balance sheet, to standardize it is to divide each item in the balance sheet by the total assets. This gives us the common size balance sheets. For income statement, to standardize it is to divide each item by sales. Now please look at the sample financial statements. If we standardize these financial statements, what will be the number of total current assets in a common size balance sheet? What will be the number of earnings before interest and taxes in a common size income statement? For common size balance sheet, total current assets for year 2009 is the absolute total current assets, 2,879, divided by total assets of 2009, 9,589. So the answer is 0.30. For year 2008, 2,150, divided by total assets of 2008, 8,310, and the answer is 0.259. For common size income statement, EBIT for year 2009 is absolute EBIT 1671, divided by sales of 2009, 12,843, and the answer is 0.13. Similarly, for 2008, it is 846 divided by sales of 2008, 9,110, so the answer is 0.093. Ration analysis is another commonly used method to draw useful information from financial statements. For ratio analysis, students are required to know how each ratio is calculated and what does each ratio measure. This slide displays the 5 categories of ratios we will discuss. When we study these ratios, students need to have the sample financial statements ready. All the ratios we calculate are of year 2009. Liquidity ratios measure a firm's ability to pay its bills over the short run without undue stress. So, it deals with current assets and current liability items. It is also known as the short-term solvency ratios. Use the formula provided and calculate the firm's current ratio and quick ratio for the year 2009. These are the answers. The difference between current ratio and quick ratio is the inventory item. In quick ratio, it subtracts inventory from current assets. Because inventory tends to be regarded as the most liquid assets except for retailers. Normally, a firm should have a current ratio greater than 1 to be healthy. Liquidity ratio is also known as the short-term solvency ratios. Debt management ratios measure a firm's long-run ability to meet its obligations, and it is also known as financial leverage ratios. Now calculate the 3 ratios as listed for year 2009. When calculate equity multiplier, we need to find common equity. Common equity is not the same as total equity. Common equity is total equity minus preferred stock. For debt ratio, you can find the information of total liabilities and total assets in balance sheet. Debt ratio of 0.55 means that 55% of the firm's assets comes from borrowing. This implies that 35% comes from equity. Equity multiplier is 2.24. When calculating equity multiplier, we need to get the information of common equity, which is total equity 4,308 minus preferred stock 30. TIE is times interest earned. This is a buffer ratio. If we compare firm A with a TIE of 1.5 and firm B with a TIE of 11.5, we will say that firm B is more likely to survive an external financial shock. Again, TIE is used as a buffer ratio. This group of ratios examines the efficiency with which the firm uses its assets to generate sales. It has two types: turnover ratios and 365 divided by turnover ratios. For turnover ratios, the higher the more efficient. Please calculate the inventory turnover ratios and days sales in inventory for year 2009. For inventory turnover, cost of goods sold is obtained from income statement, while inventory information is obtained from balance sheet. An inventory turnover of 13.85 means that in 2009, the firm turns over its inventory 13.85 times to generate sales. For this number, the higher the more efficient. Days sales in inventory can also be called average age of inventory. This means, in year 2009, the firm's inventory stays in the warehouse for 26.35 days before it is sold. This number, the lower the more efficient. The next turnover we will look at is receivables turnover. Please do the calculations for year 2009. Receivables turnover 7.93 means that in the year 2009, the firm turns over its accounts receivables 7.93 times to generate sales. Days sales and receivables can also be called average collection period. In year 2009, it takes the firm 46.03 days to collect its sales on credit. Total asset turnover is another turnover ratio students need to know. Please calculate it. And the only requirement for total asset turnover is calculations. The total asset turnover is 1.34. Profitability ratios measure how profitable a firm is. All the profitability ratios we discuss are net income related. Now please calculate the following three profitability ratios. Pay attention, here, the net income is the net income available for common stockholders. This information is available in the income statement. Profit margin is also known as net profit margin. Net income available for common stockholders is $946. Profit margin of 0.07 means that for each dollar in sales, the firm generates 7 cents net income. Question to think: if a firm has a low profit margin, does this mean that this firm is not profitable? The answer is may not. Firms can have low profit margin but large sale volumes. These firms are still very profitable. Examples include Walmart. ROA is return on assets. ROA is 0.10. At for each dollar invested in total asset, it generates 10 cents net income. ROE is return on equity. ROE is 0.22, meaning that for each dollar invested in common equity, it generates 22 cents net income. Earnings per share is another important profitability criteria. Shares outstanding can be obtained from income statement, footnote 2. However, the numbers in the income statement is in millions, so when calculating EPS, have to convert shares outstanding to millions too. Now please calculate EPS for year 2009. EPS equals to 5.29 means that for each share outstanding, it has net income of $5.29. For market value ratios, our only focus here is price-earnings ratio. You can find the price information in the income statement. For book value per share and market-to-book ratio, they are just for your information. Now please calculate the P/E ratio for year 2009. P/E ratio is 14.41. Question: if the firm's earnings per share is only $5.29, why investors are willing to pay $76.25 for one share? The answer is, the investors are not just paying for today's earnings, they are paying for the future. So, P/E ratio can be used as a measure of a firm's growth opportunity. This slide shows the formula of most ratios. Students are only required to know the ratios we have discussed so far. Two profitability ratios are of particular interest to investors, so we need to examine them in more details. The first one is the DuPont identity for ROA. ROA equals to net income divided by total assets. Now we divide ROA by sales and times by sales. This gives us the DuPont identity for ROA. ROA equals net income divided by sales times sales divided by total assets. Net income divided by sales is profit margin. Sales divided by total assets is total asset turnover. So, ROA is the product of profit margin and total asset turnover. Question: if a firm has a profit margin of 10% and total asset turnover of 1.2, we can calculate its ROA. Its ROA is 10% times 1.2, which equals to 12%. DuPont for ROE. ROE is net income divided by total equity. Now we divide ROE by sales and times by sales, divide it by total assets and times by total assets. This gives us the DuPont identity for ROE. ROE is net income divided by sales, times sales divided by total assets, times total assets divided by total equity. Net income divided by sales is profit margin. Sales divided by total assets is total asset turnover, and total assets divided by total equity is equity multiplier. So, ROE is the product of profit margin, total asset turnover and equity multiplier. Question: if a firm has a profit margin of 10%, total asset turnover of 1.2 and equity multiplier of 1.5, we can calculate its ROE. Its ROE is 10% times 1.2 times 1.5, which equals to 18%. For internal growth rate, students only need to know the definition and the calculations. The internal growth rate tells us how much the firm can grow assets using retained earnings as the only source of financing. The firm does not borrow new debt nor issue new equity. B is the retention ratio, which equals addition to retained earnings divided by net income. This slide gives a simple example of internal growth rate. Please pause and calculate it and check your answers with mine. The sustainable growth rate tells us how much the firm can grow by using internally generated funds and issuing debt to maintain a constant debt ratio. In this case, the firm uses additions to retained earnings as well as borrow money to fund its growth, though its debt ratio is constant over time. Students are required to know the definition and simple calculations. This slide gives a simple example of sustainable growth rate. Please pause and calculate it and check your answers with mine. This slide just gives student the summary of the internal growth rate and the sustainable growth rate. Please read this slide and that is all I require. Ratios are not very helpful by themselves, they need to be compared to something. There is time trend analysis, which is used to see how the firm's performance is changing through time. Also there is peer group analysis, which is used to compare to similar companies or compare firms with same SIC codes. Please read this slide, and that is all I require. For ratio analysis, there is no underlying theory and there is no way to know which ratios are the most relevant. Benchmarking is difficult for diversified firms, such as GE. Globalization and international competition makes comparison more difficult because of differences in accounting regulations. Varying accounting procedures and extraordinary events make ratio analysis more difficult.